So my name is Lisa Borab, and I am the board's bond attorney, and I specialize in New Jersey municipal bonds and school bonds. Bonds is just a fancy word for a loan. So the school district has taken a loan or a mortgage to finance this project. The only way the school district can take this long-term loan is through a bond referendum. A bond referendum is an election where you agree to allow the district to spend a certain amount of money and borrow a certain amount of money for a particular project. Those referenda can be held 5 times throughout the year. March 8th is one of those dates. So the school district will have a question that we drafted for the school district that will set forth a yes or no answer to allow them to put the additions on the schools, make the improvements to the high school, and spend not to exceed $25 million and borrow not to exceed $25 million. The board proposes to borrow that money over a 25-year period. Why? 2 reasons. You want to borrow for the useful life of the project, and 2, you want to spread the impact, the cost of the project over the generations that benefit from that project. And sometimes I use this example. I'm going to make this up. The numbers won't really be right. But let's say you need to install new boilers for $1 million in the school. So you do them in the 18-19 school year, and you have money, and you spend the money that year, or you tax for $1 million that year to pay for the boilers. Some people like that because it's not borrowing and it's not taking on long-term debt. That's terrific. So all of you that live in Fairlawn would pay for that boiler in 18-19. Then a new family moves in 1920 with 5 children that go through that school and get the benefit of that brand new boiler and never have paid a dime for it. So the ability to borrow money over time really helps spread the cost over the generations that use it. One of the other items you'll see in the referendum is that there's a state aid percentage. So the state has agreed to contribute an amount to this project. About $3.8 million, which is somewhere between 15 and 18% of the total project costs. And that state aid is in the form of debt service aid. What does that mean? It means that they're going to pay a percentage of your loan payment every year, the same set percentage every year. So the district will tax for a portion, and the state will pay a portion. And that state aid is called debt service aid, and it's only available if the referendum passes. Some people sometimes say, well, if the referendum fails, that's okay. We'll take the $3.8 million and we'll do what we can with it. You don't get the $3.8 million if the referendum fails. And then Brian will talk about some more specifics about the financing.
Yep, so my name is Brian Morris. I'm with Phoenix Advisors, financial advisor to the district. As Lisa mentioned, the total project is $25 million. The state will provide approximately 15 to 18% debt service aid, which is about $3.8 million. So the district is ultimately on the hook for about $21 million of the project. We expect to sell the bonds in July of this year for a 25-year amortization, as Lisa mentioned. July is typically a good month to sell the bonds, especially this year. There's not too many other bond sales out there, so there's a strong appetite for the bonds because of the low volume of issuance. When all's said and done, the debt service impact to the taxpayer will be $9 to the average home. The average home is valued at approximately $328,000. So that's $9 for a $328,000 home. If it's
Per month.
Per month, yes,
I think you said
excuse me,
that.
yep, per month. The annual total is about $105. And again, that's the average home. So if your home is half of that, the impact would be $4.50, or if your home is double that, it would be $18. But we use average home just as a way so that everyone can apply their unique situation.
I'm sorry, is that $9 today, tomorrow, 10 years from now?
Correct.
So that because we're spreading it
The
out.
$9 is a monthly charge. That is
Right.
an estimate based on certain assumptions. 25 years, this amount of
Right.
dollars. And what the financial advisors did is they took today's interest rate and they bumped it up a little in case rates rise by July to give a cushion. to be conservative on that impact.
Right.
I have a question. They're building these townhouses, which is probably the reason why we have to do this. With at least three bedrooms with children. Okay, they have tax ratables. They're gonna be paying school taxes on these condos or home townhomes, whatever you wanna call them. Why wouldn't that be considered as part of the cost?
Oh, once they come on the tax rolls, they will be added to
Because
the,
taxes never go down.
well, that's
Mine
true.
haven't.
But,
You're right.
once they're added to the tax rolls, the dollar amount is fixed, so that'll just be spread. So if it's $9 without them on the tax roll, once they're added on, the tax roll will expand, so that $9 will be spread through everyone, so it would go down, it would be less than $9.
The specific cost of this
You think
referendum.
about till we go down.
No, we're not suggesting that your taxes are gonna go down.
Not the taxes, but the cost, right, no,
All we
I
can
know
talk
that.
about is the cost of
The
this
cost of this
project.
project.
So if you're spreading it over a larger group
Oh,
of,
they're gonna be ready by probably the next school year.
Well,
We're
so
gonna slapping them
you
up
make
as
a good
fast
point.
as
So
we
we've
can.
made our assumptions even more conservative in that we've assumed that ratables are not going to increase. To the extent they increase, that $9
How
does go
could you
down.
think they wouldn't increase when they're building a
Because we're really not permitted to assume anything with ratables. We have to be the most conservative as we can be with this project.
What I think you're saying is,
This
what
is the
you do is you
maximum.
come up with worst case scenario.
That's exactly right.
Worst case scenario is, my taxes, because my house is your middle house. That my taxes every month will be $9 more. But it's not worst case scenario. They build the townhouses, let's say there's 100 new houses. That same $9 would maybe go down by 50 cents.
Right.
Maybe it's
Maybe it's
But it's not
$8.50.
a matter of my taxes actually going down, it's a matter of them not really going up.
Right, it's
So
about,
that amount of money will be spread over more houses.
it's the amount that your home is gonna contribute to
Correct.
pay off this loan.
Right.
So if there's more people contributing,
Right.
your percentage contributing
You're not
goes
telling the
down.
town, you have to raise taxes on Kathleen Valencia's house by $9.
Right, no.
You're doing a worst case scenario, this is what, in the worst possible case, how much the average person's house would go up by. Okay.
How much is this buffer that they're estimating that the rates could go up, like, you know?
Well, we assumed a 4% interest rate right now for the 25-year bond. Based on the current market, that is fairly conservative. If you were to go out tomorrow for a bond, what would you get in the real market? It could vary on a number of things, but, I'd say 3.25, 3.5. So,
Again, worst case scenario.
Right, that's what,
Right.
right.
So you
big-
have a good buffer in
Talking
there,
about 25 year, right?
for 25 year, that'd be the average interest rate,
It's set
right?
the day you sell the bonds.
Yeah.
Right, for 25 years it's set. So, we're right now in a rising interest rate environment. The economy is fairly strong. The Fed has been increasing the short-term rate over the last couple meetings. So all signs are pointing to rates going up. So like we said, we're targeting a July bond sale to try to lock it in as soon as possible. I think that'd be a benefit to the district. If you wait another year, who knows what can happen.
The
Rates
rate's locked in once the bond is.
Correct.
Always.
And also, not only that, but we typically issue bonds with a 7-year call. So that means in 7 years, if interest rates are lower, you can refund the bonds or call them back from the bondholders, refinance at a lower rate, and then you'd save money per year.
This district has done it twice in a few recent years. They had bonds out. I forget the years of the referendum. I think one was 2001, I can't remember, but they called their bonds and they reissued them at lower interest rates.
If the referendum fails, what are the options then? Can we then go back? You said there are 4 times a year that they do.
5 times a year.
5 times a year.
Yes, the district could decide to go back out with the exact same question. It's March, so the next available time would be September.
Oh, they couldn't get the next available.
That is the next
Oh, that is
available
it.
date. There's nothing between March, unless you have an April election date, which you don't. You have a November election date here. Yeah, September would be the next available date.
which only pushes the problem further down the
That's
road and makes it much more likely that the rate at that which we'll be borrowing the bonds will go up.
Right.
So basically, a no vote means if we come back to it later on, it's just gonna be more expensive.
Well, likely, I mean, no one can predict interest rates, but construction costs too.
Based
matter.
on what's been going on.
Right, because construction costs have been on the rise.
Mhm.
They went down for a while, but now they're back up.
Right, and the only way to get the essentially free money from the state of $3.8 million is if the referendum goes through.
Right.
Only this March referendum goes through.
No, just the referendum in general.
Oh,
With-
yeah.
At the next referendum, it probably would be available also, hopefully.
Yeah, we'd have to double check with the state, but in my experience, when it fails, if you try it again, the state lets their commitment stay out for that second try.
Any other questions?
Who buys the bonds?
That's a good question.
People,
Well, but you
Yeah,
sell them, like, are they open market bonds that anybody can buy, are you?
so we sell them in a sale in which the whoever purchased them has to buy all of them, so all 25 million. So what you get then is your large, banks, Wall Street type, Bank of
So Chase might come
America.
in, or,
Yeah,
but it's not gonna be grandma
Morgan.
down the street wants to
No.
buy.
They would buy it
They would
from
buy it
the
from
party
the
that
broker.
JP Morgan sells it to.
Okay.
Right. So JP Morgan will sell it to then your money managers, BlackRock, Vanguard, the bond funds,
Right.
and then also your broker. So a gentleman earlier asked how he could go about buying bonds if he wanted to, because you get the state exemption and a federal exemption. So you have to consult your broker, they would know the proper channels to go through.
what
Because-
rating are you expecting?
So the board currently has a AA2 rating, which is the third highest rating, so it's a very strong rating. It's above the state median rating.
This is
Um,
savings.
Well, the state itself is far
Right,
below
he
the
means
median,
of all
but I mean of all,
issuers in the
each
state,
town,
of local issuers.
That median, local rating is actually one notch below that AA3, so, you're one better than the median, so, and it's a very strong rating.
What
Especially,
factors affect our rating, I guess?
what factors?
Yeah, what's making it go up or down?
The financial operations from year to year, how much money you're building, your reserves up. Obviously, revenues need to be higher than expenses to keep building that number.
Yeah,
The
financial
tax
management,
base.
whether you're reliant on using surplus to fund your budget, or do you budget with tax monies? What does your tax base look like? Do you have a mix of residential and corporate, which Fairlawn does? What's your tax collection rate? Has a very high tax collection rate, in the upper 90s. Other towns you could imagine might have lower tax collection rates, real estate tax collection rates, so. I think they look at management, right, what else?
Yeah, they look at different financial policies, management. They look at, the big concern now is pension concerns for across the state. Obviously, at the state level, it's a big concern. So that's kind of trickled down to be a concern.
Is our rating affecting the interest rate we're being offered for the
Yes.
bond?
Yes.
Mhm.
Very direct impact. And the bonds are sold competitively, so on a date certain, we do an advertisement and issue what's like a prospectus for the board. It looks like a prospectus. It's called an official statement that goes out to the investment community. And then on a date certain, they have to bid an interest rate. They bid electronically over an electronic platform, and the lowest interest rate wins.
It is now 8:10 and session 3 is ended.
Thank you.
Okay, thank you.